So their job is not to look at funds and invest in funds, most of them at least, right? So what they do is they look at companies and invest in companies. They're good at investing companies. In reality, most people who send us a referral or send us a great fund is typically someone who has never invested in a fund.
Superclusters is the podcast to demystify the secrets, stories, and tactics behind the money that moves the venture capital world. Ertan Can has done his tour of duty in the asset management world at JP Morgan, to covering investor relations topic at Thomson Reuters, to investing in startups at a family office, to now finding his true calling over a decade back as the founder of Multiple Capital, the fund of funds focused on micro VCs in Europe, and has been a limited partner in some of the top funds you've heard of today, including Entrepreneur First, Angular Ventures, just to name a few. I also believe the first fund of funds in Europe backing micro VCs. He is a proud graduate of ESCP Business School and a longtime student of finance and law, catalyzed by his time at Frankfurt and London. Naturally, we'll chat about the evolution of Ertan's journey, but for now, Ertan, welcome to the show.
Yeah, thank you for having me. Thank you. Really enjoying it.
You have so many great friends in industry. And between our mutuals, there are a lot of folks who are like, ask Ertan about this, ask Ertan about that. So we have more topics here than we'll have time to cover, but we'll do our best. But I suspect we'll only hit the tip of the iceberg.
I'm open for it.
That'd be great. We might end up doing a Lex Friedman 8-hour podcast if our listeners will give us their ear for that long. We might edit it down in post, because between Ertan and I, we might take meandering paths, veer starboard and port, just to see where things are. But maybe to start things off, just so we have a directional heading, I'd love to start from your early life. In kind of the conversations we had before, one thing you mentioned was that you are the firstborn child of a pair of immigrants, and you lost your family early on. And I'm curious how that catalyzed in the way you think today about family, about work, and how that sets you up to be the human being you are today.
Any immigrant family a family that is immigrating to another country. In our case, it was from a very poor region in Turkey, immigrating to Germany, and then my parents became blue collar workers in Germany, and in the end created a life for us. Having, I don't know if you know about that, but in Germany, for example, education, including university education, is for free. So it's very democratic to have access to university education. I think this kind of things has an influence on every immigrant or child of an immigrant family. So family is, I think, more core for us. And in my case, as I said, I lost early on my father, not as a kid, but as a young person in university. And this has shaped my life a lot. At that moment, I had the feeling I became an adult earlier than my peers, right? I had the feeling I have to take over responsibility and take care of my family. I was the firstborn, I was the eldest. And so like all these and I was not even earning money. So I didn't have a job, but I still had the feeling I started, for example, working part-time during my studies, and it was not needed in the end, because sometimes people impose that and think you have to do these kind of things. But in the end, my personality moved more into family-related, family-focused personality, and I became a more, caring person. I think that's probably the thing. And earlier than most other of my peers, who became that maybe by the end of their 20s, and not by their beginning of the 20s.
I'm curious, is there a chapter in your life when this narrative was most prevalent, where you you put the most pressure on yourself to be the caretaker for the family?
It never stopped. I'm now, I became 50 years old 2 weeks ago. And
Congratulations.
I have
Big
thank you.
5-0.
Yeah. So I have a family of my own. I have 2 kids, and it never stopped. I still have the feeling, I have to care of them. I have to take care of them. I have to make sure that everything is in line and everything works. And I'm still, right? So it's again, it's probably not really, we're not we're living in Europe. We're living today in Luxembourg. It's a very safe environment, It's okay, really, right? So, to raise kids, and still, this thing never changed for me from the beginning, I think 30 years ago to now, it really is still the same. Kind of the feeling is the same.
I know you just shared a little bit, but there's so much to cover on that side of things. One thing I'm really, really, really curious about, and I had this question since us a day one of us meeting, is that you're in Luxembourg right now.
Yeah.
And what was there a conscious choice when you were moving, I believe, between Frankfurt and London? I mean, not London, Frankfurt and Luxembourg. Is it in general is it easier to raise a family in Luxembourg compared to the heart of Germany?
I think it's very similar, to be honest.
Okay.
I think like if you compare it really directly, it's probably a little bit better because the infrastructure and the government is, it's a richer government, so the infrastructure is a little bit better. But I wouldn't say we were living in the Frankfurt area, and Frankfurt is a stable, like it's very similar in terms of infrastructure and raising a family. I wouldn't say it's a big difference.
Was there an inciting incident that catalyzed you to move with your family to Luxembourg? Was it because of schooling? Is it become like closer relatives? Was there a catalyzing moment?
It is mainly related to starting our third fund, where we changed the structure from a German structure to a Lux structure. And because of the complications in Germany of running a firm outside of Germany, being based in Germany, we were advised to think about moving to Luxembourg. It just made a lot of things much easier and reduced the risk, long-term risk of tax complications in Germany. So that is probably one of the main reasons. And we think, like, I'm still thinking of building that that structure in Luxembourg for the next fund vehicles, and living here makes it much easier to do that.
Yeah.
And I don't know, probably most of your listeners don't know that Luxembourg and Frankfurt is like a 2.5 hours drive, so it's relatively close. When I told that to my relatives in Istanbul, they were kidding, they were laughing because they said, "Ertan, we thought you've moved to another country, but that's like going from Istanbul, the European side, to the Asian side. Sometimes it takes 2 hours by car, right?" And she said, my son is living on the Asian side, and I need 2 hours to visit him. So it's like it's the same kind of. So it's not a problem really. And for us, it's still I think a good way, for example, to keep the relationship with our friends and family in Frankfurt. It's close enough to jump in a car and be there over a weekend. I think that was one of the main reasons also why my wife also accepted doing this, right? So I think it's a kind of long-term commitment to what we do, and it's a family commitment because I've not done it. I wouldn't have done it alone. And I think it's good for our kids. I think one of the things in Luxembourg is they grow up with 5 languages. So, and so all in all, we think like we have a list of, I don't know, 10 to 20 points why Luxembourg is better than, why raising kids and living in Luxembourg long-term is better than Germany. But on the other hand, Luxembourg is also very, very, like, there's not a lot of things happening here. So if you want to concentrate and focus, it's a good place. If you really want to have entertainment and a lot of different things, and it's not the right place to be.
Speaking of focus, one of the main reasons I live now out in East Bay, in the Bay Area, is it's a suburban life. There's lots of families around, and one of the great things is there's not enough noise, right? Like, when you want to really, truly, truly focus, being in the suburbs is way better than being in San Francisco proper, where I kid you not, there are sirens going off at like 3 a.m. and you're like, oh, I can't even sleep properly. And then not only that, there are always events going on in these pockets in the city as well. And SF is only just a portion of the night activity, the night owls that exist in New York and LA as well. So I will say it sounds like the relationship between like Frankfurt and like Luxembourg is probably very similar to like, city versus suburbs.
It is probably the case. So Luxembourg is a city, but it feels like a suburb, right? Mm-hmm. So it feels like a very suburb-like city life. And you still have the benefits of a city, walking and having public transportation, all these things that Europe makes to what it is. And but in the end, it's not noisy, right? There's no
Okay.
real nightlife in Luxembourg. There's not like it's not super crowded, and
Yeah.
it's kind of silent, you know, uh, a city in Europe, and it's a very small city too. So it's tiny. People forget that the city is only 180,000 people, and the country is I think 600 to 700,000 people. So it's smaller.
Oh,
The whole
wow.
country is smaller. Yeah, it's the whole country is as large in terms of population as Frankfurt is, and Frankfurt is also small. It's just 700,000 people living in Frankfurt, but Luxembourg, the whole country is like 700,000 people.
I didn't know that, but that makes a lot of sense. Even like, you know,
Yeah, man.
per capita, I like, back when we were studying economics, we were kind of looking into the European region as well. At least this kind of checks out with kind of my early studies. Um, I would be like, my audience would kill me if I never asked about this because you did tease this early on. One of the reasons you moved to Luxembourg was because of tax reasons of setting up a fund of funds, right? Were there other
Mhm.
contenders when you were considering moving out of Frankfurt that your advisors, and I will also preface, this is not legal investment advice. This is not tax advice. Go consult an actual professional on this. But this is just me scratching my own itch. Like for you, were there other like
Mhm.
cities, countries that were contenders of for you and your family to move to, but you ended up choosing Luxembourg?
So yes, we thought about, or we looked at other countries within the European ecosystem as well, and so we looked at Switzerland, we looked at Cyprus, and we
Hmm.
looked also at Dubai, and I think they're all there are benefits and disadvantages for all of them. For us, the main decision for Luxembourg was the being very close to Frankfurt and
Hmm.
being able to be in Frankfurt within 2 and 3 hours without any planning. So that is, I
Yeah.
think, the main reason why we. And the other main reason is that Luxembourg is the main hub for setting up funds, right? So Luxembourg is the fund industry number one in Europe, and I think number two in the world. It's
Oh,
just
I
the
had no
whole.
idea.
Yeah, I can talk about that if you want. I think
Yeah, no, absolutely.
so Luxembourg is the go-to jurisdiction in the European ecosystem for fund setups. And Luxembourg was historically an industry nation. So they were like in the steel production, I think 50 to 100 years ago, one of the biggest steel production countries. But when steel production went to other continents in the world, Luxembourg like re-identified as something completely new, which is the financial hub for fund setups. So today, many of the global, not only European but global funds set up their fund structures in Luxembourg. The large private equity firms like KKR, Cinven, you name it, they all have Luxembourg structures. I think in Europe it's number one, and globally even it's probably number two, maybe number three. I don't know currently where the standpoint is, but for Europe, most of the institutional setups are in Luxembourg, and there is no real alternative to Luxembourg. Now that UK has left the European Union, is also UK became kind of offshore. So yeah, if you don't want to have an offshore jurisdiction like Cayman, BVI, Guernsey, Jersey, Luxembourg, and Delaware is probably are the two go-to places in the world.
You took the words right out of my mouth. I was just going to ask you, like, is Luxembourg the equivalent of Delaware out here? And it sounds like it is.
Yeah,
Um,
absolutely.
this,
What Delaware is for the United States or
yeah.
North America is probably Luxembourg within the European ecosystem. And for many outside of the European ecosystem, still like Swiss money, for example, if they are raising structures, they still raise it in Luxembourg.
And so when you're investing in funds, because you invest in pan-European funds as well as funds domiciled in Germany and all that, there's a level of like sector specific, but also like geographic specific, depending on the
Correct.
thesis. And I don't want to misquote you here, but it was something along the lines of you'll invest in generalist, kind of focusing on a single country or a single like area,
Hmm.
versus you'll invest in specialists who are more pan-European in nature. And so, kind of when you're looking at these funds, and also correct me if I'm wrong here, but like if you're when you're looking at these funds, um, are you asking them to, for example, like we only invest in Luxembourg incorporated funds, or are there other alternatives? Or are you more open to these? This gets more tactical and more like legal jargon nuance, but that's something I've
Yeah.
always been really curious about.
In Europe, you have to be open, especially for emerging managers and venture. You have to be open for different jurisdictions. I think we have more than 10 jurisdictions now in our portfolio, from Luxembourg, Germany, UK, Jersey, Guernsey, Netherlands. So many of the Eastern European funds, for example, choose Netherlands because it's cheaper than Luxembourg.
Okay.
Estonia, which we are a big fan of. I think Estonia is, compared to Luxembourg and Netherlands, the fund service providers in Estonia are like tech companies. So it's I think, a very interesting hub for emerging managers. But the reality is that if you're an emerging manager in France, you tend to raise a French structure. If you are an emerging manager in Germany, you tend to raise a German structure, and it works, right? So it's not perfect, but I think it works. You can set up a fund in your home jurisdiction, and it's also recommended because you need some kind of substance. That is the whole discussion. I mentioned there were some tax complications why I moved to Luxembourg, and I think if you want to stay in Germany, it is recommended to have a German structure. We think that a Lux structure for us works better, but we couldn't do that easily from staying in Germany running a Lux structure. So that's one of the main reasons why we moved from Germany to Lux to run the Lux structure. So that is maybe the answer. I think we have today Estonian, Finnish, Netherlands, Germany, France, UK, also Delaware. So many of the European managers, emerging managers, choose a Delaware structure. Yeah. So people with a US background or LPs, let's say you have 50% of your LPs are from the US, it really could make sense to have a Delaware structure. So this happens. A lot of UK managers, for example, have a Delaware structure and a UK advisor, and that is very common. I think in our last portfolio, probably like 20 to 30% of the funds are Delaware structures.
Interesting. And as you're looking at some of these funds, just because if a fund is French incorporated versus Luxembourg incorporated versus Estonia incorporated versus Delaware incorporated, for you, do you have an advisor that covers each of these geographies when you're assessing a fund and deciding if to invest in that fund? Or are the terms similar enough where you can, I'm not a lawyer by training, but that you can kind of like agree on things in broad strokes?
So to put it in simple words, I think that is, by the way, one of the reasons why we choose Luxembourg. We have a structure in Luxembourg that gives us the possibility to invest in very different structures globally. Okay, that is maybe the one big reason why we choose that specific structure in Luxembourg, to be able and more flexible in investing in different structures. Still, there is a learning over the last 10, 11 years, what we can do, what we can't do. And yes, we have two legal advisors, one for Lux and one for global things. If it's needed, and most of the time it's kind of tax-related questions when we have to look into a fund investment, then we will, ask them to make a due diligence on if we have the feeling we don't know that structure well enough to make a decision. But in general, we, with our current structure, are able to invest globally, and that should be legally as well as tax-wise work well for us.
Gotcha. I mean, I'll be honest, I can go on forever asking about these questions, but if our listeners couldn't tell, we've gone off script already just because I am scratching my own itch and out of personal fascination. Yeah. If we were to take a step back, I kind of want to talk about multiple capital. Not kind of, I do want to talk about multiple capital. I mean, a large part of this is the impetus for the conversation as well. But if I remember correctly, you started your kind of like career in venture post MBA at a family office, and your initial kind of inception to it was they asked you to invest directly into 20 companies, I believe in Germany. You quickly realized that your zone of genius was not necessarily in direct investments, and ensuing after, like, you found your special sauce in kind of investing indirectly. I'm curious for you, how did you eventually convince your LPs to switch from direct investment to investing in venture fund structures?
Yeah. So when I started with the family office, the idea, I mean, they've never done venture or private equity before. So the idea was they asked me to do private equity, and I've never done this. And I I didn't know what they really mean by that. And so I went to that to the first conversation I had with them, and what I realized, they wanted to invest early founders, right? And I convinced them to back tech founders. So because part of the MBA was also like venture capital, and tech investments. So I've never done it. So it was really like first time. And I loved the learning curve, the education that I had. But I realized really very quickly that, first of all, I'm not the right person. I don't think I'm the right person to be a direct early stage tech investor. And second, even if I would be, it's just a very tough job for family offices, for a family office unknown somewhere from Germany to compete against the top funds and top angels trying to invest into those earliest stage companies. So I went back after 1.5 years to the family and said, thanks for the opportunity, but that's my learning. So I don't think we should continue doing this. And they were kind of shocked. And I said, there's like, I explained to them, I'm probably not the right person. And I think our setup, the family office, is not the right setup to invest in early stage companies. And I've done already like 23 investments. And I felt already that will not really make a big difference in terms of returns for us. So they said, okay, thanks, Ertan. What should we do? Should we fire you now? And I said, no, I have another idea. And by then, I met a few GPs. I understood what a venture capital fund is. I talked with a lot of GPs and tried, because they wanted to also talk with us as a family office. So I realized, okay, that's interesting. And so I learned what a GP really is, a fund is. And then I convinced the family office and I suggested, why don't you let me invest into funds instead of companies. And by the way, I have a fund investment and fund of fund investment background, by the way. So I even, one of my first jobs was in a fund of fund in Germany, back then in, mutual funds, public listed funds. And so I had the feeling it's a much better fit to me personally. And I had the feeling it's a much better fit to a unknown family office. And back then there were literally no one investing. There was no one investing into early stage funds across Europe. Most of the LPs and family offices invested in their home country in one or two funds. And I convinced them. I said, let me travel Europe and find the best managers, and let's build a pan-European VC fund portfolio. I didn't even mention micro VC fund portfolio. And so they liked the idea. They said, yeah, that makes sense. Why don't you continue? So I started in 2013 to invest for them. I call it my first portfolio, and invested in 10 funds for them over a period of 4 to 5 years. And back then, having you have to understand that back then in the European ecosystem, there were maybe 50 to 100 VC funds per year. It was a tiny deal flow, right? So it was easy to go to Finland and look at the 2 to 3 funds. In Estonia, there were maybe 2 funds. Back then in Eastern Europe, there were 2, 3, 4 funds. It was super easy to screen that, to spend a lot of time with them. Even in the UK, there were maybe 5 to 10 max funds back then, calling themselves or being a small seed stage focused fund. So there were not a lot of funds. And so it was easier back then to talk to them, to reach out to them, to speak to them, to have a better understanding of the total ecosystem. And then, I did every year, 2 to 3 commitments over that period. And I think it was we were very, very lucky with that first portfolio. It was an incredibly well-performing portfolio. It's one of the things when you're first and when you recognize something that no one else is doing in an ecosystem that is really starting to develop. We just benefited extremely from that last decade in the European ecosystem of tech companies built. And yeah, that's the beginning of Multiple.
I love it. And I'm curious, did your process of underwriting a fund back in 2013 change over the course of time? How did you pick one of those 2, 3 Estonian funds or 5 French funds? And obviously there's a lot more in terms of just sheer number of funds in the world today, even in Europe, right? Yes. But I assume the process has changed over time. So could you walk our audience through how the process has changed?
Yeah, so it was, again, back then I had really time, and it was a learning process because I spend also a lot of time with each manager. So it was very different. And in the end, if you look at 50 and you select 2, that is probably like the ratio is similar to the 700 to 800 funds that we look today per year and invest in 10 to 12. So it's like the ratio haven't changed. The number of funds is just much, much larger. And of course, we had to be much more efficient looking at funds, right? So we know today much better what we really want to see. And there is a lot of noise because there's like one thing that I'm saying all the time is funds look so similar today. That's one of the big problems for LPs, in my opinion, because funds get there's so many, how are they called now today? Fund accelerators and mentors and people who advise you how to raise a fund. That makes the funds don't differentiate anymore. They look more and more similar. They have the similar decks. They have similar, slides in the deck. They have the same. Many of the funds have very, very, very similar focus. And it's more difficult for us to differentiate. But at the same time, we had so many learnings over the last 10, 11 years that we know very, very well what we want to see, what we want to focus on. So we can eliminate like 80 to 90% of the noise very quickly and then focus on the 10%. And that's, again, a deal flow of maybe, real deal flow of maybe 50 to 100 funds per year that we are, spending more time with, trying to build a relationship, reference them over time, see what they are doing, see how they raise, see how they invest, and then make our commitments. And something else, what happened in the last 10 years in the European ecosystem, what was completely different 10 years ago is the existence of specialist funds. So 10 years ago, most of the funds were generalist funds, geographical generalist funds, right? So the fund in Finland investing into Finnish startups, the fund in Germany investing into German startups, the fund in UK investing into British startups. So you didn't have really the specialist funds. You didn't have an AI fund, a blockchain fund, a life science, some life science funds, but they were more old school life science, large private equity like venture funds. But early stage micro VCs focused on life science, you didn't have that 10 years ago. And so it was, I think this came on top in terms of deal flow and also portfolio. Today, in our current portfolio, 2/3 of our funds that we do per year are probably specialist funds, and 1/3, so 3 to 4 are generalist funds.
I have one question, and then you say something, I'm like, oh man, I have like 5 more questions. Speaking of proliferation of questions, if I could double click on something you said earlier, you mentioned there's a bunch of fund accelerators out there today, right? And you often see the same decks and same templates. And
Correct.
For you, I guess 2 questions here, but I'll say the first one first, is like, does the templated similar deck approach make it easier or harder for you to evaluate funds, given that there's a set number of slides, a set, set of topics for these slides as well?
That's my opinion. For us, it's much harder.
Okay.
The thing is, there is no, like, if you would look at inefficient markets with KPIs, let's say funds that are established, fund number 5, and if then you would receive a similar deck and you can compare the benchmark, could benchmark the funds, you could compare the KPIs, etc. That's probably a different thing. So that's a benefit, for investors, for LPs to look at established funds with some KPIs available. For emerging managers, small funds, there are no KPIs available. So if you look exactly the same, if 10 funds send me the same deck, how should I, it's almost impossible. So the time for me spending reading decks decreased over time. So we have many more decks, much more decks today, but my time spending reading decks have decreased over time. So I'm reading less decks today, and decks are less important for me. And I'm really I'm probably like everyone else, I'm spending around 5 minutes per deck. I think in our deck, the average LP spends 2.5 minutes. So I think that's the reality today, that most people are so, there's so much noise in the market that there is literally no time to spend really a lot of time in especially into detailed decks. So I always recommend, probably like funds recommend to startups, keep it very short, right? Keep it extremely understandable what you're doing. Have a slide about the GP, right? So who are you? Why are you the guy that person that that I should back? And then what's more important for me are today referrals and the time spent in a call. right? So speaking to the people or meeting the people. So that is probably more quality time, because DAX became quantity, and quantity is not helpful selecting the right funds, in my opinion.
I always get a lot of questions on referrals and introductions in general. I'm curious for you, do you have a stack rank, a priority list of like who or how the referral comes in? For example, I imagine, I don't want to put words in your mouth, but I imagine like a referral from a portfolio fund manager ranks higher than a referral from maybe a family friend. But do you have like a general stack rank of this?
The highest rank for me is not the portfolio manager or the GP in my portfolio, because they are typically not looking at funds. So their job is not to look at funds and invest in funds, most of them at least, right? So what they do is they look at companies and invest in companies. They're good at investing companies, but they are not the typical LP. So the highest rank for me are LPs that are similar to me. So investing in a lot of funds, looking at a lot of funds, and have a real opinion, right? So being very opinionated about funds and GPs. So in reality, most people who send us a referral or send us a great fund is typically someone who has never invested in a fund himself. Right. So that is not really a proof, right? Like we have even an internal joke when we speak to family offices, we very often get a no without any reason. But then the next step is 2 weeks later, we receive a deck from the family office, and they are claiming like, this is a great fund, Ed, and we've seen a great fund that should be a perfect investment for you. And I was like, guys, you've never invested in venture. You just told us you're not investing in venture. Why do you think that you are able to select a perfect or great fund that we should invest in? It's just this kind of experience that we have sometimes. And I think there are several LPs who, especially also like individuals, right? So some of the wealthy individuals are very active LPs. So they're looking at a lot of managers. It's a tiny portion of the total market that does that. And some of the GPs do it. And I think that is the respectable, that is the kind of referral that I really respect or has the highest relevance for me when looking at funds.
And so if I were to draw an analogy to this, it's the equivalent of like, if your friend has never eaten, let's say, Ethiopian food, and they're like, this is the best Ethiopian restaurant in like the world. And you're like, you've never had it before. And similarly speaking, let's say, for example, I have an Asian palate. I love Asian food. I love South Korean food. I love Japanese food. I love just like Chinese food in general. And I will trust someone more when they recommend an Asian restaurant to me if they also have an Asian palate. Versus if they have more, let's say, an Italian palate. I'm like, you know what? I'll trust you on pasta. But, or like, I'm overgeneralizing. All the Italians are going to hate me for that. But I probably would trust them a little bit less. Not at all, but like a little bit less when it comes to like an Asian palate.
And this is so obvious. Like we're not talking like magic stuff here, right? So it's not like math that we are talking about, right? So it's so obvious, it's so basic in my opinion. And still, like, because there's not really a lot of experience doing this, people think when they have seen a first deck that looks great, that they have to recommend it to a fund of funds like us. It's like if you have never invested in a startup, and the analogy with food is great, but if you have never invested in a startup, and I'm like an active investor in, let's say, in 100 startups, and then the first startup you've ever seen, like a friend of yours is raising money for a seed round, and you say like, Ertan, look, this is a startup, you should invest in them. Yeah, that's a startup. I know, it's like one of those few hundreds that we see a year, and we're just selecting the best, and that's our job. That's why we are paid a fee, right? That's where we're getting a carry in the end. I think that is something that is totally misunderstood, especially for fund of funds in the European ecosystem. It's still considered very easy to invest in a fund. Most people underestimate the work behind it, looking at the whole ecosystem and then selecting the right funds, because most people just invest in the funds that knock on your door. When you're talking about a family office in Germany or France or something, they're not looking at Finnish funds or Swedish funds or Estonian funds or Latvian funds or, Hungarian funds or, all these other geographies and verticals that they typically don't even understand. So they are just waiting until some of the local funds knock on their door because they have access to them. And then they look at 2 or 3 funds and they say, okay, we should do a venture allocation. And that looks like a good fund. It's French, it's local. They're also in Paris. We can visit them from time to time. They have an AGM that will be great. And that's the reason to invest in that fund.
I 100% agree. It going back to the analogy of like, if someone sees the fund for the first time, they're like, Ertan, you've got to see this fund. It reminds me a lot of, so I went to school in Berkeley, and Berkeley every year there's like 40,000 students. And one of the funny things is every so often I meet someone who's like, oh, I know a Berkeley person. Do you know this random person that I've heard went to Berkeley? And I'm like, there are way too many students. And for me to even like say like I've heard of this person, but it reminds me a lot of that as well. Kind of the second question I have here on this thread is, you mentioned earlier that it's relatively easy for you to turn down funds for like 60% of your deal flow, give or take, maybe more. You kind of look at it and you're like, this
80.
is not a fit. 80.
Yeah.
My hearing's bad. I think I have an advanced a declination of my audio. But thank you for correcting me. So 80% of funds are just like, you know what, not a fit for our fund. Some of it might just not fit in your thesis. Like, for example, a Thai fund is probably not going to be your thesis because you're not investing in Southeast Asian funds, right? Although I'm seeing you nod your head now for those who are listening and not watching.
We have a European mandate. Or no, we don't have a European. We want to be a European fund of funds. We think like being in Europe, having like really access to the European ecosystem, and we think we are true believers in the ecosystem in Europe. So we think there's great talent and great tech companies that can be created in the European ecosystem. Now, can we invest outside of Europe? Yes. So 20% of our portfolio can be easily, could be Southeast Asia, could be MENA, could be US, could be LATAM, could be Africa. We've done an Africa-based funds in our last fund. We've done several US-based funds in our last fund. So it's an opportunistic bet, but we don't claim to screen the Southeast Asian market, for example. We don't claim to screen the African or LATAM or, outside of Europe, we're not screening. In Europe, we screen the whole market.
Listeners, this is why Ertan has never hired me to do his PR, because I have misrepresented that thesis altogether. But that said, like that makes a lot of sense, right? Like 80% of what you're investing in is where your edge is, where you have a zone of genius in, and 20%, give or take, at least for in your case, is you're opportunistic in the sense that there might be great opportunities outside of Europe. So I stand corrected, but given that 80%, give or take, of your deal flow is easy to screen, are there outside of your thesis, but like are there red flags you typically see in decks or in early meetings that when you talk with emerging managers, you're like, if I see this, I won't invest? Do you have
there are
something
many
along those
red
lines?
flags.
Yeah,
there are many red flags. I think they're the common red flags that, I don't know, in the European ecosystem, everyone wants to raise 100 million plus fund, right? Even in a first time fund. This is like, for me, it's a big red flag, especially if they are reaching out to us, because we make it so public that we are investing into micro VCs, like very small VC funds. And we even give that number of 5 to 50 million in most of the cases. We do sometimes exceptions above 50 million, but that's so rare. And that is so exceptional that, if you are a fund above 50, there is almost no reason to reach out to us. But other things, red flags that are not so obvious are, for example, most of the time, many GPs reach out to us when they have an idea of raising a fund. And it takes sometimes 2, 3, sometimes even longer until they've raised the first fund. So it's a period of 3 years sometimes where we have a relationship, where we build a relationship. And then we realize, in the decks that things change. And they change from, I don't know, 3 years ago, we want to be a blockchain fund. 2 years ago, or last year, we want to be an AI fund. Today, we want to be a climate fund. So this is like one of the biggest red flags, I think, for us, especially if the background of the GPs has like no relevance to those fields, right? So that's, if you want to be a specialist fund, you need a kind of specialist background. You need to be, someone who has an insider view on what you want to really do. And you have to build a relationship also with the founders. So if I'm not a blockchain native person doing a blockchain fund just because blockchain has a bull run, doesn't make sense to me, right? You have to speak the language of other blockchain native people. And if you want to invest in climate tech, I think many people believe, like many of the real founders believe so much in what they are building. If you are not authentically investing into this kind of vertical, this will be like, they will see that very quick, right? So that you're not an authentic climate tech investor. So I think this is probably one of the big red flags for us. And another red flag, unfortunately, is the kind of random team building, right? We are strong believers of solo GPs, so very small teams. So we don't need the kind of team that you have to present, right? And building a team in a partnership like a VC fund is a very, very long-term decision, right? So it's like, one fund has on average a lifetime of 14 to 16 years. That's like the average number globally for, especially early stage funds. Now, you're in a marriage of 15 years with your partner, with your first, like in your first fund. If you are planning to raise several funds, this is like a 20 plus year partnership. You have to really think well about who you are adding to that partnership. So again, for us, we would rather invest in a solo GP who really thinks he has something and presents it to us and wants to raise a very small fund to do investments within that field. And comparing to someone who has like build a team, then change the team, build another team. Within 3 years, like 6 people came and went, and this is another red flag for us. And we try to also give them the feedback. You don't have to. It's not really necessary to build that kind of team. But unfortunately, there are several LPs who love that, right? So they always want to see a team of 3 partners and 3 juniors and a team of 5 to 10 people on their website. And only then they believe this can be a real fund, which is not true. You have all these examples in the US with Elad Gil and Oren Zev. They manage billion plus funds and they're solo GPs. And I think this is starting to be accepted in the European ecosystem. In our last fund, roughly 1/3 of the portfolio were solo GPs. Today, I think, again, 1/3 to even 50% of the funds we look at and we are interested in are solo GPs. So there's a change in the ecosystem. 10 years ago, this didn't exist. There were no solo GP in the European ecosystem.
And so to kind of like talk about the topic of solo GPs and all, you and I both know there are a lot of LPs out there who ask for partnerships in the very same way a lot of like VC firms go like, hey, we only invest in co-founders. We don't invest in solo founders, right? Because there is an element of in their there's a very true risk, don't get me wrong, of being only by yourself and not having a sounding board to be able to diligence deals, think about things, because we live in our own myopic view of the world. And sometimes it's easy to lose track of what's happening in the wider world if you don't have a sparring partner, so to speak. That said, we're also seeing now, and this is circa March 2024, at least when we're recording this. My editor's going to kill me because like sometimes we're not supposed to call out when we're recording these things, but I think this episode will come out soon after. We're starting to see a lot of partnerships break up, and a lot of LPs realizing that the new partnership is not the partnership they initially invested in. And there are some folks like my good friends at, for example, like Kybernite Capital. They're like, hey, let's just completely rebrand, and it's a completely new firm, and it's a completely new fund from day one, right? But there are other folks who are like, hey, we had 3 partners before, and now we have 2 partners, and then the LP's like, this is a different dynamic altogether because we invested in all 3 of you because you all kind of complemented each other. Sorry, very long-winded question, but kind of my ask to you is, you're a solo GP yourself for your own fund of funds. And as someone who's a big fan of solo GPs, how do you think about checking your own blind side when you don't have necessarily a partnership to act as the sounding board? Like, to you, does the sounding board matter? And if so, like, how do you hedge your own decision making?
It's a very good question, and I think being a solo GP is not the perfect solution, and there are downsides. And one of the downsides is you don't have a sounding board if you don't have it, right? So I think many solo GPs build this sounding board if they need it through advisors, venture partners, and even like solo GPs talking to other solo GPs, right? So if they're co-investing, for example, right? So and they have like a close network of other solo GPs, and they understand that there is a lacking part, of being solo. But if you're like 2, 3, 4 solo GPs and you come to discuss deals and maybe even invest together, this is the kind of sounding board that you probably have instead of having a second partner in your fund. So it's like, I think being a solo GP is not for everyone, right? There are very specific personalities that are that where it works well to be a solo GP. I think it's very opinionated people, so people who have a very clear view of something, and it's like kind of lone wolves. So people who work really well alone. And you see that in other areas as well, like their solo legal advisors, for example, extremely well, right? Extremely smart people work alone. They don't have a team. They get like 100% and they think they're doing a great job, and they don't have any juniors. They're like perfect examples for this kind of things. And I think within venture, that's what we see. It's not for everyone. So I think there is a portion of solo GPs who start solo but want to be in a partnership, in their second fund in the future, and start already looking for a second partner. And I would say probably 50% of them are like that. And then there is this other type of personality where the solo GP wants to stay solo, and they want to keep a small fund. They want to work in the same kind of way how they work. They don't want to build a firm. They don't want to increase the AUM. They want to just live and work and think that they have a how do you say that? Like that they have an advantage, an unfair advantage doing this, right? Having small checks, being extremely specialized, being citing here Oren Ziv, being extremely quick in decision making, not thinking about any partnership distractions, IC meetings, etc. Being just very quick and yes, I want to do that, and we have only a few days time and we have to make it happen. Now, this is different from what we do, right? As a fund of fund, I think for us in a fund of fund, it's again a little bit different, right? It gives me a lot of flexibility and freedom to select funds, and I think we do, for example, especially what I do, investing into solo first-time funds where a lot of things don't look good, right? So there are tons of reasons to say in an IC meeting, no, we shouldn't do that, right? So there's like so many reasons when you invest in early stage VC, and not the typical perfect setup early stage VC with 3 partners, everything is perfect, etc. 50 million fund, 100 million fund, backed by the European governments, etc., where everything is like perfect, neat. No, we're doing the exact opposite. We're investing into the 10 million solo GP, never invested in as a VC before. So it's a really big bet that you do. It's a high risk bet, I would say, because you might think from a general view of a family office, that's super. Why would we do that? There's tons of reasons to decline that investment. And if you have to go into a partnership and do an IC meeting and discuss this opportunity, yes, there will be 10 reasons to not invest into that fund. And there will be very few to invest into that fund. So there is a risk that, let's say, if I have 2 other partners, that 2 other partners will say, Ertan, we should skip that fund. And I think it's one of the benefits of what I'm doing. And I think it's one of the reasons why I probably want to stay solo GP as long as I can, to be able to make decisions on things where I can be very contrarian and hopefully right again, right? So I think by design and by the learning and by the experience I have, this is the kind of niche that I have, being contrarian and right in selecting with my thesis very small funds that invest in very specialist, very early stage technology in the European ecosystem.
I want to talk about making contrarian bets. You mentioned very similar to like a pre-seed founder, but like a fund 1 GP without much of a track record. There's a lot of things that can go wrong. There are a lot of things that are like up in the air, so to speak, right? In your mind, have there been historical examples for you that have really made you say, this can go really right? I will invest, even though all these other things could be better. This one thing or these 2 things are really, really trending in the right direction, that I want to take a bet on this $10 million fund 1.
So there is from time to time a kind of, we call it no-brainer, right? So very, very opportunistic, where we see there is kind of opportunity that looks really good. An extremely, let's say, capable personality, trying to do something different, getting a lot of feedback from the market positive, still trying to raise a much smaller fund than he could probably, right? So, some of the managers who raise a 10 million fund could easily raise a 50 or 100 million fund, but sometimes it happens that they are raising a 10 to 20 million fund. And that's, for us, it's a big benefit. If we see this kind of opportunity, yes, that is like interesting for us then to invest in. But in general, to give you like the real answer, to be very, very honest, the one thing and the one main thing that I've learned over the last 11 years is that I know that I don't know, right? So that is probably, one of the biggest learnings, because like we are an ultra diversified fund of fund. We invest in each fund of fund, we invest in 30 plus funds, and those 30 plus funds invest in roughly 1,000 startups across the ecosystem, across verticals, across geographies. The biggest outlier we had in the last 10 years was in Romania. No one expected that, right? This kind of outlier. The second biggest is in France. Again, no one expected that. So it's a kind of, what we invest today and what will be the next outliers of the next 5 to 10 years, it's impossible to know that. It's just, that's the main message that I have for every new LP. You can't predict. It's so difficult. Everyone talks again about the next blockchain bull run, and blockchain might be, extremely important in the next decade for the tech ecosystem. Yes, but it might be life science that changes the world, right? Mm-hmm. So, and the thing is, with early stage tech, within a 10-year period, we just don't know. And that's why I would never, like, for us personally, I would never focus on just one specific vertical because I have an opinion about that specific vertical. That could be great, but it could be also completely wrong. And that's what I'm like truly believe in, that I want to be as diversified as possible. So I'm backing, funds that did AI 6 years ago. So the first AI fund we backed 5 to 6 years ago, and when no one spoke about AI, but we thought, okay, that's person is like ultra convinced about AI, and he's like pitching really interesting as a small fund, as a solo GP. That makes totally sense for us to diversify also, AI in our portfolio. And then we realized half of his portfolio were life science companies. So we increased our life science allocation by investing into an AI fund. So that was a complete surprise to us. But that's what I'm saying. So what we do is based on, I think, surprising things. If we could predict the best things at the earliest stage, and sometimes I'm getting asked this question, Ertan, why do you invest in 30 funds? Just tell us the 3 best funds and we're going to invest into, we can help you also. If I would know which of the 30 funds, which 3 of the 30 funds will be the best funds in my portfolio, I would put all my money, all my private money, all the funds money into that 3 funds. We don't know. No one knows. Yeah. And that is the reason why we are investing into 30 funds. What we do is, in the end, we increase the probability of having some of the outliers in our portfolio, right? So we will always miss out, right? There will be always funds that we will not have declined, or not really declined, but chosen another fund that is similar over that fund. And that, it happens all the time. So we're missing out, of course. But our work is to increase the probability of having some of the outliers as early as possible in as small as possible funds, because that will lead, like a fund, that will lead to a power law in our portfolio, and that will lead to extraordinary returns, even in the European ecosystem. So people forget that in the European ecosystem, we pay like half of the valuation compared to the US. So this is like a lot of these things. What we want to do is just to improve slightly the probability. And the other thing, for example, that we don't do is we don't time markets. A lot of LPs, as you know, especially family office, they think, now is a good time to invest in venture. But last year was a bad time to invest in venture. And next year it might be a bad time again. And the year after it's a good time. So that's, right. It doesn't work like that. If you could time venture, because venture, if you invest today, the outcome is in 5 to 10 years. How do you want to predict that? It's impossible to predict the timing. And the funds that is investing in the worst time, let's say in, this year and last year, is considered really a bad time in venture, right? Lots of late stage companies had markdowns on their valuations, no new capital invested, a lot of tourist LPs and VCs, left the market. it's probably it could be one of the best vintages, and we will see that in 5 to 10 years, not today and not next year. And that's what I'm trying to say. Like, we are investing every vintage. We don't want to miss any vintage because we think any vintage could be the outlier vintage.
Yeah. And I think there's two things to kind of remember here. One, innovation is secular to macroeconomic trends. It's not like when the economy goes bad, the smartest people in a given field go like, hey, I'm going to stop building. I'm going to stop innovating, right? People are always going to be building. Like, smart people are going to be building, and they're never going to time the market themselves because that's their ethos. The flip side of this is that the marketing we're investing into is not the market we're exiting into. And so because of that, we can't assume the exit potential of the current investments are what the current multiples are, but rather knowing that economies go up and down and in cycles and all that, that given that how low things are right now, there's a good probability that things will be much higher in 5 to 10 years.
Correct.
Because of how markets move. On the same time, like, when markets are really, really hot, in 5 to 10 years, you may not be seeing the same markets. Like, the valuation multiples of like 20x, 30x, 100x, so to speak, right? Those are not sustainable. And the exit markets for that, as we're seeing right now with the IPO markets, at least in the US, are a little a lot lower than 20, 30x.
Again, like, I don't have an opinion on that, right? So
Yeah.
I think, again, like, whatever it is, if we have the right companies in our portfolio, and again, we think we improve the probability of having the right companies in our portfolio, and whatever the exit market is, we will benefit from it, right?
Yeah.
So, and it might be again, like, sometimes, people ask me questions like, oh, Ertan, what if the next 10 years tech will be dead? Like, if tech in the next 10 years will be, I can't even imagine. We're talking about, the 7 largest companies in the world are like tech companies today, or something like that. I don't know the difference. But every single CEO, even in the European ecosystem of any established company, believes that technology is driving the companies also. They have to change the companies into more a technology related company.
Right.
So the core belief is technology changes everything. At the same time, we get questions like, oh, what if there is no tech exit in the next 10 years? It might be, and maybe there is like a global war, a world war number 3 globally, and
Knock
there's
on
like
wood,
nothing
hoping
is
none of this
happening.
happens.
But then this happens, then this has an effect on everything. Not only on venture and tech. This has an effect on established companies. This has an effect on real estate. This has an effect on infrastructure. Everything will suffer in this kind of extreme black swan moments. We think that if markets exist, and if Europe and US and all these markets exist, first of all, tech companies become very, very quickly global companies if they are successful. It doesn't matter where they are born. So that is something that people always misunderstand. So a company doesn't have to be born in the US to become a global company. It can be born in Romania and can be a global company at some point. We invest at the in the infant space. So when they are babies. So when they are babies, they don't have to be a US company. But if they are strong and growing, they will become at some point a US company, most probably.
Right.
This is for tech. It's like the kind of, but when you back them in the earliest stage, you have to think about 2 engineers or 3 engineers who have an idea somewhere in Europe or in the world. And if you're able to back those engineers, that could be the next Spotify, that could be the next UiPath, that could be the next Soraya, that could be the next, big outlier out of Europe. By the way, UiPath, most US people that I speak to, they think it's a US company. It's
That's
like
true.
a US tech startup.
That's true.
It's not.
I mean, a lot of people.
It's a European. It's a European tech startup.
I hate to admit it, but like the people in the US think US is the center of the world, which I would love to believe that, but realistically, it's not true. But they think there are certain like great companies like Shopify or Spotify. They're like, oh yeah, they're US companies, and we're like, no, they're not. They're not domiciled. Their main HQ is not in the US. The founders didn't start the company while they were in the US. And I love seeing these great stories from Canva and
Canva, exactly. Great,
Canva.
unbelievable story.
Oh my God, I love that story and the amount of like mental and physical fortitude necessary to pull that through. for those that are curious, would highly just Googling like Melanie and the team and Canva's story from their beginning days, and how hard of a journey that was. But now, obviously, they're a multi-billion-dollar company.
Mm-hmm.
To switch gears here a little bit, Ertan, I've never asked this question on the pod before, but I couldn't help but uncover this in the process of doing homework for this conversation, which is the topic of venture partners.
Mm-hmm.
In Fund 2, which I believe was around like 2019, give or take, like I want to say circa around that period of time. In Fund 2, you started bringing on like great venture partners, namely someone like Michael Jackson. And for those that are listening, this is not the music legend incarnate, as far as I know, unless Michael has a prolific aptitude in music. But this is the brilliant VC Michael, who's based out of Paris, and who also happens to be the creator of some of the best VC memes on the internet, who I absolutely adore. And so I'm curious, what are the behind the scenes discussions, behind the curtains discussions, when it comes to deciding, one, to pursue a venture partner strategy, to including a strategy where there is a venture partner, and then two, deciding who to pick?
Yeah. For us, it's a very natural evolvement. So I'm not like, hiring or looking for and then speaking to 50 people and then selecting the venture partner. It's a natural evolvement. I think, Michael, we just started to like each other's posts and comments and thinking. So we started talking at some point, right? And then we talked regularly, and that became, in Fund 2, it was more an advisor role. And then in Fund 3, it became a venture partner role. And it's not like a fully operational role in this case. He's helping out. It's more like what you said. It's a kind of sounding board for me, right? So it's like a regular conversation with him, but he's not involved in, for example, setting up the structure or fundraising or doing the due diligence of funds. So that's not his part. He's helping with. He's super connected, so he's a super connector, super networker kind of person. So if we have a question about a fund, a person, if I want to have a sounding board speaking about something very specific, he's just extremely knowledgeable and experienced in a lot of fields. Not super in depth, like not, but he's very like in so many fields a generalist, and he speaks to so many people that this is the kind of helpful side of Michael for us. Of course, at the same time, he's also sourcing GPs, has an opinion on GPs, sometimes sourcing LPs as well. But he has also like lots of hats, right? So we're not the only thing. But in general, venture partner for us, it's like a natural evolvement. To give you another example, I think we always lacked the operational side, building a fund of fund like ours on all the like compliance, legal, tax, all these things. And I always had the idea, if I find someone who has this kind of background, it would be great if we can onboard him as an advisor or as a venture partner, and then they can help us really with insights on how to look at things and how to have a bird view on those operational stuff. And the other, so that's another example of adding a venture partner. I think the third example is fundraising. I'm just thinking about adding a venture partner in the Asian ecosystem, mainly for building relationships to LPs as a venture partner for multiple. But the other idea of a venture partner or having a venture partner is also testing out a potential partner, right? So I think I'm not the person. As I mentioned, I'm a solo GP. I'm not the person who's like identifying another person, and then knows immediately, okay, I should hire this person or give this person a partner role. It's not happening in my life, right? So that's not the type I am. So for me, it's like working with someone together, and I think the potential is someone in my team becoming a partner at some point, right? So that's a high probability. And the other probability I always tested out is having a kind of venture partner and then increasing the time working together and seeing if that's really a fit, if there is commitment enough to be a full-time partner, right, in the fund. And that's a kind of testing periods, working together, and sometimes it goes into that direction, and then we need more time. And then sometimes you realize it's not the right fit, right? It's not a partner. It's not a full-time partner role. It's super okay for being a venture partner, but it doesn't evolve. It doesn't develop into a partner role, right? So that's the kind of thinking for me about a venture partner role. I think many funds have a very different approach here. And I think it's also different for a fund of fund versus a fund. And people forget, for example, that fund of funds most of the time have much less budget in terms of management fees because we have half of the management fees. So that's maybe another reason to work with venture partners who are really senior profiles and can help you with thinking about specific things. But we couldn't pay like a team of 5 partners. That's another thing that people always forget.
And on that note of like, venture partners and bringing them on, like that are adjacent to the ecosystem, that are well connected in their own right to a specific subset, whether it's GPs or LPs or founders and all that. How when you're let's say raising fund 2, or like, even if it's not during the fundraise, how do you communicate that story that you're bringing on a venture partner to your LPs? Is it something that you have in writing from when you're beginning, like, hey, I'm carving out X percent of management fees just to find someone eventually? Or is it more opportunistic? Let's say with Michael's case, like, was it just like, Michael's great, love him, how do I bring him on? And then you have that conversation with your LPs then and there.
Most of our LPs are not institutional LPs. We don't, typically don't discuss this kind of things. I think it's, again, the thing for us is it's a natural evolvement. So there's no plan to add another venture partner for a specific area. If I meet someone and I have the feeling it's the right person, the person has interest to, we start talking about it, and at some point we might start working working it out and trying to work together. That is not something that we typically have to inform LPs, really, because in the end, the team is like, the core team is fixed. The core team is very stable, and it's also a lean, very small team in the end, right? So I have one junior. He's something like a chief of staff. He's helping me on everything, and we have 2 freelancers who are helping us on a regular basis, and then we have 1 venture partner and 2 advisors. And I think that can change. Like, advisors, if we realize that it's not the highest ranking anymore within their other advisory mandates, and that could happen also with Michael's case. In Michael's case, if Michael, I don't know, decides to join full time as a partner any funds, maybe he doesn't have any time anymore, to focus on our stuff. So this is something I think LPs have to be like aware that this is not something they can count on for the next 15 years, that, someone like Michael will stay as a venture partner in our fund. It could be that he evolves into a partner role in our case. Probability is low unless we raise, I don't know, a few hundred millions. But that's the reality, right? So will we have other venture partners during the next years? Probably yes. It's just a natural evolvement. If I have the feeling there is someone really adding value and potentially a great person to work with, and potentially even a potential partner in the future, yes, I am. And it's a benefit for most of the LPs. If I think that is the case, our LPs and the fund will benefit from it.
That makes a lot of sense. To switch gears a little bit, you mentioned this a couple times in our conversation so far, which is outside of multiple, you also have a personal quote unquote angel portfolio. And I say angel in quotes because all your quote unquote angel investments are into other funds. And so I'm curious for you, outside of fund size and check size, could you compare and contrast the decision making for when writing a small ticket quote unquote angel investment into a fund off your own balance sheet with a check coming out of multiple capital?
Yeah, indeed, it's a different kind of process. Multiple is an institutional fund today, so we are audited. We are doing a quarterly reporting. We need some kind of specific reporting. We have an external AFM. There is an external IC official. Like things that have to be in place. So a lot of things has to go through a due diligence, and we have to check a lot of boxes, to invest with multiple, even in a small first-time fund. We're doing 1 million euro checks. This is like the process that we need in place. Now, doing a 1 million euro check means also the fund has to be around like 10 million minimum to be able to invest in funds. Some of the managers I've backed as an angel are tiny. You call it maybe nano or even smaller, like proof funds, pilot funds, 1 million, 2 million, 3 million vehicles. And we couldn't invest with multiple into those vehicles. So these are the kind of funds that, I can't back with multiple. But if I like them, I would like to back them as an individual with a small angel check. So I'm not a wealthy person. It's really similar to many of the other GPs in the world who are not wealthy, but still, when they are not a VC doing angel investments, tiny angel investments. So that's the kind of work that I do. And to compare those two processes, my private investments, there is no real due diligence, right? So I talk to someone. If I really like them, I believe in them. It's just a small commitment. And I truly believe that this is like a gut feeling, commitment. And it's not a due diligence based commitment. There is also in most cases no real due diligence to do. So what do you want to do in due diligence in a 2 million fund that is raised on angel list? And so either you believe in it and it's kind of higher risk, but not as high as investing into a company, right? It's still diversified. It's still like probably not, you're not writing off that investment, but it could be that its investment is only delivering 1.5 or 2x in the worst case, right? So that's the downside. But in the best case, it could deliver 5 to 10x, which is compared to a strong company that you invest as an angel, could be a 100x company, right? So it's a different thing. But that's a kind of risk taking and investing on my personal side, next to my, of course, large GP commitment that I do in my own fund, right? I think the biggest, the biggest allocation of my private money, personal money, is in my own funds. But again, besides, if I can't invest with multiple, there's always a potential angel check that I'd like to do into those very small funds.
That makes a lot of sense. As we're rounding out, and we're hitting the last leg of the relay race over here, I have a couple more questions. And one of the things in talking with a bunch of mutual friends is that you are really good at giving feedback. And so I'm curious, as someone who likes their coffee black, and that's something I've found out. I was like, this guy doesn't have cream or sugar? Like what? Like, Ertan, who are you? But as someone who likes their coffee black, how do you think about impressing upon GPs the bitter truths of the market today? And do you have a preferred medium of how to give feedback?
So I think the two mediums where I share a lot of what I think about the market unfiltered is LinkedIn and Twitter. And Twitter probably even more unfiltered than LinkedIn. LinkedIn is we're trying to, most of the inbound interest comes in LinkedIn. So we try to be a little more business oriented. Okay. But in Twitter is really Twitter is pure opinion and sometimes completely unfiltered. And I think that is one way to share. I think what most people in, let's say, outside of Europe don't know is that I'm speaking at almost every week at a conference in a panel, most of the time about emerging managers. So this is another way of, and I'm known for giving unfiltered opinions. So I'm I don't have any government LP invested in me. I don't have any corporate LP. So I'm completely free in saying what I think is right. And I think that makes, I think the feedback that I get is always that it's very authentic compared to a lot of other panels that they see in the European ecosystem speaking about, as an LP investing into emerging managers. And that is probably the biggest, the biggest medium. And the other things are podcasts, for example. Thanks to you guys and similar ones, I'm spreading, what I think about the market and how we think about first-time managers, solo GPs, emerging managers, European ecosystems through podcasts. And that's the way how I communicate, I think, or bring the message to the world. Because, honestly, I just realized I haven't been to the US the last 10 years. So
what?
I haven't been to the US, and a good friend of So I just realized it myself. It's unbelievable, but it's true, and I'm planning to go there this year. It's the first time for 10 years, and but a good friend of mine is doing has done this Kaufman Fellowship, and he said, Ertan, when we there were 100 Kaufman Fellows in that program, in that class, and he said when when we asked about the go-to LPs for micro VCs, emerging managers, you were like always mentioned between the first three names, and I was like shocked because most of the people are in the US, joining that Kaufman Fellowship, and I've never been to the US in the last 10 years. I've only one conference I visited was in
Don't
Toronto.
tell that to the Kaufman Fellows.
It's like, well, it's like I was so surprised about, wow, how do they even know about me? Like, and we have not really actively investing a lot in the US. So we have maybe 10 funds in the US. So how do they even, like, they found out somehow, and that was really surprising for us that Multiple has even a brand in the US, and the US is a very competitive fund of fund market, right? So it's like there are probably 100 fund of funds in the US and probably 20 to 30 micro VC focused fund of funds today in the US. So we were never aiming to compete or be visible in the US. It was, I think, never our aim to think, hey, we could even compete or be visible in the US. Never aimed that. And our aim was always, trying to be very visible in the German and European markets, and that's what we wanted to achieve. But that's the kind of thing when you talk through LinkedIn and Twitter and do podcasts. I think people in the whole world listen to it and see it, and that helps to become more visible. I think it's in the end.
And to use I believe this is a younger millennial word, maybe a Gen Z word, but you are a beast when it comes to content. You are highly visible. You get your thesis out there, and they're contrarian takes. So I'm going to give a shout out to your Twitter and like LinkedIn posts here, but you have this series of social posts, which I just call like fundraising number, whatever it is. I think you're on fundraising number 44 right now.
Yeah.
Which I guess
something like that.
Something like that, right? Like I think the next one is like fundraising 45. But if anyone is ever curious on the hot takes that Ertan has about the world of VCs, LPs, I would highly, highly recommend checking out the post where it says fundraising number 44, fundraising number. Like I literally love fundraising number 14. So I think you've called that back a couple times as well. Go for it.
No, I just wanted to say everyone has its favorites, and I have my favorites. And interestingly, my biggest favorite fundraising post has probably the lowest likes. So it's so interesting, and it's like thinking long term. Like what I think this one was about. Everyone speaks about 5x or 10x returns.
Yeah,
and I tried to explain what that means if a fund returns 5x and if an LP could return 5x on his portfolio every 10 years, because some people think that is realistic, right? And if that would be the case, I just put a very simple math model that we would be all passive billionaires within a few decades.
Yeah.
Even with starting small amounts of investing. That's the proof that it's almost impossible to have this kind of returns. Even 3 times money every 10 years over a long period, several decades, is almost impossible to get.
Yeah.
And so that is probably like my favorite post. And I think I got like 5 likes.
I think it is also, correct me if I'm wrong, but I believe that's also your longest post because it is nuanced.
Yeah, correct.
And I will say people on social media, especially Twitter, they have rather short attention spans. So
yeah,
it is a really good one. So I forget what number this one was, but it is.
I have to. Several people asked me to summarize it, like put it on Notion or something, and like so to make it easier to find. Yes, I will do that in the next weeks, I think, because so many people asked for it. I started fundraising number 1 just because I had like an idea and I wanted to post it, right? And then I started next day. I think in the beginning I did it like almost every day. I had like a few things that were burning under my fingernails and I wanted to share that, right? So it's common wisdom. It's also like experience, learning curve that I had over the last 10 years. I always had the feeling I should share this with the market. And I never thought that, this is super interesting for many, but it was interesting to me. And I thought for some, it will be interesting. Like it's always a small proportion of people who are interested in this kind of shared experience. And I think it's like 100%, again, unfiltered truth, in my opinion, that I want to share with the publicly. And I think I will continue to do that, especially about the European ecosystem, about micro VCs, about fundraising. In that case, I started another series about Luxembourg.
I did
But
see
it's
that.
it's
I think
just
it's like you're
I
on
think one or
Luxembourg
two.
number 1 or number
Yeah,
2, something like that. Yeah. It's a good
number
one.
two, I think. Yeah,
That's
yeah.
fascinating. So I want to go back, and this is my last like hard-ish hitting question. But I kind of want to go back to the thread of feedback. You've shared how you think about giving feedback
Hmm.
to kind of like the broader ecosystem, and there is so much to chew on from what you've put out there already. But I'm curious how you give one-on-one feedback. So let's say a portfolio fund manager comes to you and asks like, "Hey, Ertan, we're trying to do this thing. Do you have a framework for how you think about giving feedback to your portfolio managers?"
No, I don't think so. That we have a framework for feedback. I think there are specific areas where I can really add value, like thinking about, for example, portfolio construction, thinking about the structure of the fund, thinking about legal and tax things where you can always ask a lawyer, but you can also ask an LP like me or other LPs who have done it a few times, so that you can get first-hand experience on what to look at. So these kind of things, I think it's always including like recommendations for service providers. I think it's so difficult to find the right service providers, and so many people do mistakes that these are the things where I can help with feedback. I think, in my personal opinion, that most of the time, feedback that we can give is limited to these, like especially I can give is limited to these areas. And I'm asked a lot of feedback around thesis and other things, and team, for example. I think there my feedback is always limited. In the end, I would spend maybe an hour thinking about it. You as a GP spend weeks thinking about it. You will be the specialist, and I can be a sounding board. Sometimes if someone is open to it and is willing to share and have a sounding board, but most of the time, I realized that we are more a passive investor. And maybe it's also the case that most of the things work quite well in the funds. And that surprises us as well. I think we had one fund with a team conflict very early on. So I was in the LPEC in that fund because it was a very new fund and they had they had not a lot of experience in running a fund. So and they had very early on in the first year in team conflict, and it was two GPs, three GPs, and one was about to leave, and then there was like a conflict for 6 months. So we went every week into a call, gave feedback, tried to negotiate, tried to mediate, and that was probably the toughest thing for us, seeing a problem. Most others, and that's maybe a good thing, in investing into small funds, small teams, solo GPs sometimes, that their focus is extremely aligned, and their long-term alignment is also like given, because they're not having a lot of management fees at the moment. So they are focused on the investments and getting the carry long term. So this is a kind of alignment that really works well, I think, for the kind of funds that we invest in.
I dig it. I dig it. Sometimes there's just no framework altogether, but I've heard so many people say that they've enjoyed their conversations with you and they learned so much. So I was curious if there was something there. So kind of to round out the corner here, one thing you
Let
wrote,
me say let
yes.
me say one thing, David. Let me say one thing. I think when I compare the last 10 years, when I started 10 years ago, 11 years ago, I met so many smart people in the ecosystem, right? Really smart people, like super branded people, much better backgrounds than I have, and very smart. The one big difference, I think, that makes me also like probably an interesting sounding board or giving feedback is most of those people changed. So they did three, four, five different things in the last 10 years. They never stayed course. I don't know if they never continued to do what they believe in, or they never believed in something 100%. I think my biggest difference is not that I'm smarter or better educated or, kind of like more privileged or, all these things. I don't write well, for example, right? I'm not a good writer.
That's a lie.
I don't
I've read
speak
your
native
writing.
English. So,
I've read your writing. It's
I
really
mean,
good.
these are like 2 sentences, but I'm not good in like writing long stuff, long texts. I'm not a native English speaker. So one of the reasons probably that is always like people don't realize that. But if you think about, going to a tech conference today, 95% of those people speaking are native English speakers. You have very rare non-native speakers. So all these things, and still I was like, I'm focused on what I'm doing for 11 years. And I'm like 100% focused on what I'm doing, exactly the same thing. And I think that is the biggest difference compared to a lot of other people who do a lot of different things. They are, in German we say, they're dancing on different weddings. And I think I always were dancing on my own wedding. And so it's like, I think that brings the kind of that people believe that you have to share something that makes sense, right? So that can help. It's just the pure focus. I think that compared to many others I have. If you think about GPs, they changed so much. If someone has a small GP 10 years ago, today some of them manage 500 million under management or more, right? In the European ecosystem. So everything has changed completely. They do a different work. They have a different setup, different team, different day. So for me, it's all the same. I'm talking about micro VCs all the time. And I think this is like compounding in the end. And this compounding effect is probably the biggest value that I can give back when I give feedback or speak with people. I think that's probably the most valued thing.
And I do believe there's like a flywheel effect because you've stayed so focused on micro VCs for so long that you've seen the evolution of micro VCs, specifically micro VCs, over the course of time. So you can share like best practices, red flags from a decade ago, today, and it's all as relevant. And although history doesn't repeat, it does rhyme.
I totally agree.
So last question here, and I've had you longer than I initially promised, but I enjoyed every second of this. Coming up on 3 years back, you wrote that great founders and emerging VCs should have 2 key traits: be like a cockroach and be a superhero. And then you followed up in saying, and we can pull up the tweet, and my editor can pull up the tweet later, but then you also said you have 50% of the aforementioned. Has your mileage changed since? And if not, which half are you to date?
I think I feel more like a cockroach than ever, to be honest. It's
Elaborate.
It's like really, really, look, raising a fund of funds in the European ecosystem. And if you speak to other European fund of funds, you will probably get the same message. It's one of the toughest thing ever. And I totally underestimated it. Right. Mm-hmm. So it's like the fund of fund ecosystem has not evolved, and people are not like, they don't like the idea of investing in fund of funds. The maturity in the market still does not exist. Look, we have 10 years experience, 11 years now experience, 2 funds deployed. The first fund has DPI and everything. If we would be in the US, we would be probably, I don't know, managing 10 times more money, would be a superhero. Right?
You are a superhero to the Kaufman Fellows. Like, people in the US know you. They see you.
Yeah, for them maybe, yeah. But most people don't know the details, right? So the details are that we're still small, AUM wise, we're still small. We still feel like a cockroach, right? So it's like you could call us super cockroach, right? So we're still not really flying. We're still extremely resilient. We're still bootstrapping. We're still like, we don't give up. I think that's like the thing that makes, again, a big difference. But at some point, it's also we're still not in the superhero setup. We're still in the cockroach setup. We're not giving up, not dying, continuing, bootstrapping, still being lean, right? And all these things together, the real answer is I'm probably more a cockroach than ever today.
I'm curious because you said you're not yet a superhero, and to a lot of others, you are very much of a superhero. For you, what is your personal definition of being a superhero?
I think, when you are starting to do what we are doing, and one of the requirements is that you have stable, consistent capital available to back those managers. So I think today I'm still spending more time on raising the capital and making the capital available to be able to invest in emerging managers. And I think I should spend 80% of my time with emerging managers. That is probably my definition is spending 20% on fundraising and admin and 80% on identifying and speaking and building and selecting emerging managers, and maybe doing more around investing into emerging managers. For example, more podcasts, more content. This is super limited, and that's one of the reasons why my content is very, very limited most of the time. The other reasons, I'm not good at writing, as I said, but the one thing is, if I have an idea, I try to put it into words within 5 minutes, right? And that's the time that I spend with content. VC funds, large VC funds, have whole content teams, right? That they think about a strategy of putting content into the market. Like, they have PR teams, they have PR agencies. We don't have all this. And that's why my content looks like as it looks. But I think the ideal scenario, doing what we are doing, is spending as less time as possible with raising capital, having available capital, also long-term available capital, and focusing more on building the portfolio. I think that's the target where we want to be in a few years, hopefully. We're still spending too much time on raising the capital and on administration. I think probably more than 50% today on fundraising and administration, and less than 50% on investing and speaking with emerging managers.
Well, as wrapping up here, I don't want you to discount yourself. So I will say there is an immense superpower in being able to write very succinct and powerful tweets and LinkedIn posts. Because as the Mark Twain line goes, and I'm paraphrasing here, most people run out of time, so they end up writing a longer letter, right? And there is something to be said where people end up regressing to writing long essays worth of things that could be way punchier. And I think there is a superpower that you have that, I'm going to be honest, my tweets and LinkedIn posts are just way too damn long. And I regress to the following. It's like, hey, you know what? I don't have the time to figure out how to boil a very, in my mind, which is not always the case, a complex topic into something that's punchy and insightful. But you're able to do that again and again. And besides for one thread of your fundraising number, ... like XX, every single one is like 2-3 sentences long, and you come away, you're like, holy frig, I didn't think about that before. So I highly, once again, do recommend people to check that out. And hopefully we'll see more content from you from Luxembourg and fundraising soon after. So as we're rounding out here, Ertan, you're everywhere. We mentioned you're on LinkedIn, you're on Twitter, you have your email out there. Where's the best place for people to find you?
I think it's on LinkedIn and Twitter. If it's really, if you want to share a fund with us, right? So if someone is interested in having feedback on their fund, the best way is to reach out to our website. It's so massive. Meanwhile, the deal flow, that we just created a link. It's a contact us button, but it leads to an Airtable, and then you fill out like 5 minutes questions, and that gives us, and you can upload your deck if you want, or share your DocSend link, and that gives us, so the whole team that is looking at the funds, the best way to screen the fund as quickly as possible with the relevant information that we need. Most simple things. To give you an example, we ask for the fund size, right? We don't have to look in the email or in your LinkedIn message, which is like a long text again, or in your 50-page deck to find out what your fund size is, to say yes or no in the first day. The first thing to do.
Right.
The same thing as stage. If you're a multi-stage focused fund, it's just a quick no for us. And so this is the kind of making it more efficient for us, but as well as for the managers if they want to reach out to us. And everyone else who wants to just speak with us, I think LinkedIn is probably great. By the way, Twitter, so the ratio LinkedIn messages versus Twitter messages is probably 100 times. So if someone wants to reach out quicker, Twitter is probably better.
Ertan, I count myself fortunate today to be able to speak with one of the first and foremost experts on the European venture ecosystem. Thank you so much. This has been so fun. And when you're in the US, wherever you are, I would love to find time to meet in person.
Thank you. Thank you so much. It's unbelievable how you were prepared.
Hello, Superclusters fans. You've seen the logo at the beginning, and now we're here to address the elephant in the room. And the big question is, how intertwined is Superclusters and Alchemist Accelerator? And the truth is, Superclusters and Alchemist Accelerator are two completely separate entities, other than the fact that it is only I, David, your host, who is able to traverse between the multiverses. And so the reason Alchemist is a sponsor for Superclusters is the same reason why I ended up joining Alchemist. And it's for two reasons: the team and the product. So let me elaborate a little bit. For the team side, I was doing a bunch of diligence, homework, reference checks before I joined Alchemist. And I stumbled across a story which was between Ravi and an early team member of Alchemist. And for the sake of this story, I'm going to call that person John. So Ravi and John were working late at night because they had a deadline coming up. And as they were about to leave, Ravi found out that John didn't have a place to stay and had been sleeping out of his car the entire time. And the next thing Ravi did literally blew my mind, which was Ravi gave the keys to his place to John and said, "John, you're free to stay here for as long as you want." And I knew instantly that this is the team I wanted to join. This is the culture I wanted to be a part of. The second thing is the product itself. Alchemist has built this really robust product called the Vault. And it is the epitome of Peter Drucker's infamous line, which is, "You cannot manage what you don't measure." And so for the uninitiated, what is Alchemist Accelerator? Alchemist Accelerator is your startup accelerator for companies that monetize from enterprises. And so don't take it just from me. We've backed incredible companies, including names you've heard of: LaunchDarkly, Prevacera, MoEngage, and we're also backed by some incredible LPs and investors, including Khosla Ventures, Mayfield, Salesforce. And now, between you and I can't share any of the numbers, and if I do, our compliance officer, will literally gobble me up for breakfast, lunch, afternoon tea, and dinner. And personally, I'm too young to die. But I will say, the numbers, they're great. They're really great. And so if you're curious and want to get involved in Alchemist and the ecosystem, check out alchemistaccelerator.com/superclusters. And that's superclusters with an S at the beginning and at the S at the end. And we'll also include these links in the notes. Hey Superclusters fans, this is David from Post and want to share a few things before you go. If you're tuning in from the YouTube universe, and if you like this episode and you want to see more of it, consider subscribing. It's free. Let us know down in the comments which LPs you'd want to see next, or topics you liked and want to hear more of. If you're tuning in from the audio universe on Spotify, Apple Podcasts, or wherever content finds your ear, and you liked what you heard, give us a follow. And lastly, want to share a quick disclaimer from our legal friends. While I am the head of investor relations at Alchemist Accelerator, and that Alchemist Accelerator is one of our proud sponsors, the views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice, and any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor near you prior to making any investment decisions. And that's all from me. See you on the next.